Hello, welcome to the stock play of the day. Today's stock is the XLF. This is the ETF that tracks the financial sector. We'll discuss, should we pass or should we play? Hello, everybody. My name is Brian Overby. I am the Senior Options Analyst with Ally Invest. I will be your host and market analyst today, and my colleague Lindsey cannot join me. So I'm just going to jump right into it. We're going to do a little bit of a shortened version of the stock play of the day. We're going to talk about the XLF, which is the financial sector. But first off, we have the S&P 500 index here. If we look at the S&P 500 index, we see, well, it's kind of been a choppy market. We had the big run up and then a little bit of a pullback, got a small gap on the chart here from the highs after the coronavirus times. We had a little bit of a gap, and now the market just really can't decide where to go. It seems like a lot of the moving averages are still they're pretty heavy in the technical analysis world, in that we see the 20-day moving average has provided some support and some resistance on both sides. We got the 200-day moving average that's also doing much the same. Right now, it appears that the 20-day is one of the stronger moving averages, and it's providing a little bit of protection to the downside. If we do breach that, I think you might see the 50-day moving average coming into play. But right now, we had a good sign in that the markets are running up, even though we had some rough news over the weekend in the coronavirus world. A lot of the tests have came back, and a lot of people, there seems to be a resurgence of a lot of people that are getting infected with the disease since we've had the opening of the economy. But the market is still being strong, and we did see the VIX index come down a little bit. Now, the one thing that is true is that the VIX, the volatility index, it broke above 30, and it's still trading that high. It's right around 33% implied volatility. Now, that's the volatility that tracks the S&P 500 index, which chart we're looking at here. And the fact that it's came off a little bit is helpful, but it's still at elevated levels. So there's still a lot of nervousness in the marketplace. Now, if I change the chart up here and let's go to the NDX, you'll see that the NDX appears like nothing has ever happened, right? It just leads the market forward. We've had all-time high recently in the NDX, and all the FANG stocks, that's Facebook, Apple, Amazon, Netflix, Google, or Alphabet, all those stocks are still leading the market higher overall. So the tech industry has been real strong. The S&P 500 index is a little bit laggard, and the Russell 2000 doesn't really know where it wants to go. It leads the markets lower and then leads the markets higher, and now it's just back into the chop mode. So with that said, I'm going to jump right into the XLF. This is one of the industries in the XLF, the banking industry, that's really been kind of tough overall in that we have interest rates dropping precipitously to the downside, which in some instances can hurt the banks. But we've had a lot of programs that have came out, like the PPE, that the banks have been in charge of and had the benefit of processing some of those loans. So where we've had extremes in the travel industry, we had extremes to the downside, and then we had a big bounce back, even though things hadn't really changed in the industry. They got some funding from the government. But overall, those marketplaces have made a big run back, and now the markets are going back down again. So I kind of think the XLF just overall has had that same type of movement. We see from the chart here, we had the big run up when the S&P 500 index and everything was rallying, and now the market has came back down, and now we got a little bit of chop in the marketplace. All right. So we're just looking at the general sector, and we're going to look at more of a FOMO trade, a fear of missing out. We've used that term a lot here in the coronavirus times, if you will, ever since the unprecedented move to the downside because of this virus. So we're going to look at that again. We're going to look at a short put spread. And here it is inside the Ally Invest options playbook. We're going to look at a short put spread in the XLF. Now, by doing this, we're going to be selling a put below the current stock price, and then we're going to be buying a put even further below for protection. So we're selling the more expensive put option contract, and we're buying the less expensive option contract. So the one that we're buying is just providing some protection. We're taking some of the credit from the one that we're selling to buy us some protection on the downside. But when we sell the put, we're saying we'll be willing to buy that underlying stock at that strike price. So we've got this chop in the marketplace. The XLF can't really decide where it wants to go. Does it want to start trending higher, or does it drop a little bit to the downside? And if I actually go back and look at the XLF, let me add the graph here. Let's look at the 20-day moving average here overall. 1 second. And we see that there's a little bit of downside. Oh, the 50-day moving average. So here's the 20-day MA, which it has breached, which kind of means to me that the 50-day might be in place. So we're looking at right around the 23 level on this chart in the XLF. So that's the main reason why I'm going to pick that strike. I'm going to look at selling that 23 strike put, and we're going to go a little bit further out in time. Now, to compare it to the S&P 500 index, right? The S&P 500 index is above the 200-day moving average. The NDX is quite a bit above. The NASDAQ is quite a bit above the 200-day moving average. So this kind of shows you just that the financials just in general have been lagging the market overall. So we're going to look and say, well, if the market will come down to this level, would we be willing to buy 100 shares of the XLF? It's a $23 index, $23.77 at this point in time. If I wanted to buy 100 shares, that would be $2,377, and that's what it would cost to buy 100 shares of stock. So it's a viable stock to be able to purchase 100 shares of it. This is the level that we're kind of targeting here, right down around that 23 level, but the markets are very volatile. So instead of just selling the put, saying that we would buy that stock overall, we're going to sell this put, and then we're going to buy some protection. And we're going to take a little bit of that credit, just a smidgen of that credit, and we're going to move down here to the 21 strike, and we're going to buy some protection that will protect us from 21 on down if that underlying market moved. So that's one way to address it. So if I'm doing this and I'm looking at this trade, my total risk is going to be from 23 down to 21 if I'm looking on the graph here. But my concept is that I'm willing to buy 100 shares if it will come down to that level. So I'm bullish on the market overall, but I just want the market to come down a little bit. And we're going to use options to try to position ourselves, as opposed to just putting a limit order in and saying, oh, if it comes down to 23, I'll buy it. We're going to go out and try to use the option contracts to accomplish that goal and bring in a small credit to your account. So let's get it into the Ally Invest option chains. And we see right now that basically the market in the XLF is flat. The SPX is up a little bit, but we're seeing not much movement in the XLF. I'm going to go out to the July expiration. We have decent implied volatilities in the market. We're seeing right here, if I just pull this up, I'm seeing the at-the-money option contract, the 24 strike call option. Over here is the IV column, is trading at about 40% implied volatility. So we're selling some implied volatility. That's part of the reason why we want to look at doing a short put spread, is because you're bringing in some quote-unquote juice by selling this. We're going to go out 25 days. July 17th is the expiration date. We are going to sell the 23 strike put, and then our protective put is going to be the 21 strike put. So we're going to be 2 points wide. When I looked at the trade to start with, it was right at 50 cents. I like 50 cents better than 44 cents. But we do this show live, so we got to take what the market gives us. So our official paper trade for this week, which is not meant to be a recommendation, we're just trying to learn. We're looking at when we get in a certain situation, how can we use options to try to achieve our investment goals? So this isn't necessarily meant to be a recommendation, but here's what we're looking at. If I put the trade in the right rail here on the Ally Invest option trading platform, we're looking to buy the July 17th 21 strike put, and at the same time sell the July 17th 23 strike put. The midpoint credit is 44 cents. You can't always guarantee a midpoint fill. That would also be our max gain. 44 cents minus the commissions, you got to take that out, is the maximum we can make. But we make that maximum as long as the stock stays above 23. Now, if the market goes down, we have protection at 21. So the width of the spread, which is 2 points, that would be $200 on every 1-by-1 spread, minus the net credit received. So 2 minus 44 would be $1.56 or $156 for every 1-by-1 spread. And also you got to remember to add commissions on the risk factor. That's going to be my maximum risk. I have a higher probability trade because the market just needs to either stay where it's at or go up in price. So there's a couple of scenarios. It could even come down a little bit, and I could still, at expiration, if it just is above 23, I can make the maximum on this trade. Now, next up is to decide to yourself, do you really want this underlying stock? Would you be willing to buy it if it came lower? If that's the case, then you're just going to put the trade on. You're going to kind of let it ride. Well, did the market come down? Did I end up buying the underlying stock? And if I did I buy it at 23 and was the stock below my long put, my 21 strike put? Well, if it is, then there's something that I want to do about it. If not, I just let them put the stock to me. I get to keep my 44-cent credit. I end up buying it at 23 minus 44 or 22.56. That's where my cost basis would be at. Now we've got to add commissions on all that. Now, if that's my goal, this is one way that we can address it by just selling this put option, but we're buying some protection. And in this marketplace, protection is pretty important because obviously volatilities are high for a reason because there's a lot of uncertainty out in the marketplace. Now, the other way to trade this is that I don't want to buy the stock. I think the stock will at least stay where it's at or drift higher. So I'm going to sell it and I'm going to manage my risk. The maximum I can make on the trade is 44 cents. So I might say, well, I don't want to buy it if it comes down and I see this thing trading for somewhere about double what my maximum would be. 44 cents times 2 would be 88 cents. If I see it trading around that level, I'm just going to close it out. I don't want to lose more than I could make on this underlying trade. So that would be my approach. And then also to the upside, if the market did go up and I could buy this back for 5 cents, 10 cents, probably going to just close it out, just remove the risk overall because we do have some time here. We're going out about 25 days in time. That's what the July 17th expiration is. So in the near term, if I could buy this back and close out and remove any of the risk, and I didn't really want this underlying stock, well, that's the way that I would approach it. All right. Well, that's going to be it for this edition of the Stock Play of the Day. Let me see if we have some questions in the chat box. And I also want to remind you, before I give that sign off, that we have the Ally Invest Digital Conference, which is going to be this Wednesday. You can find out more information at youtube.com/ally. And I have no questions in the chat box right now. We normally will answer questions if we do get them. Right now in the chat box, we did put in the actual link to the Ally Invest YouTube channel. And then I did have one comment from last week. So let me get this question here and I will try to address it. It was a very good question. It came in from, it was John M. Okay, John M. actually asked, Brian, how do you decide which stocks to look at for possible option trading? And where do you get the resources to strengthen your assumptions? Thank you both for putting on these weekly shows. They have been immensely helpful in educating me on how to trade options. Well, great. That's awesome. And I really appreciate that, John, the comments, and I appreciate you tuning in. When I'm looking at option chains for trading, what resources do I usually use? I mainly use our option chains overall. One of the biggest things that I'm looking at when I'm making my decisions on the exact strategies is things like the implied volatility. For example, the XLF, I was looking at maybe buying an option contract outright in the XLF. That was a possible way to do it. But then when you see the high implied volatility, well, that makes me lean towards selling something, either doing a short spread or a long call spread. Because when vols are a little bit higher, that's going to make me approach the strategy in a different facet. So that's mainly what I'm looking at. And the other thing that I'm always concerned about, now you have to make your forecast on the underlying stock if you want to use technical analysis, fundamental analysis. But if I am looking at doing a potential trade, I want to make sure that it's a fairly liquid option contract. In other words, I want the width between the bid and ask spread on the options to be fairly small. And if I'm trading in a stock that it doesn't have a lot of volume in it, the option contracts are even going to have less volume overall. So if I'm taking this approach, I just want to make sure it's a liquid underlying stock. All right. All right. I guess that's going to be it for this edition of the Stock Play of the Day. Now I can officially sign off. Please click subscribe and ring the bell. I will be back this Friday after our digital conference to do the Stock Play of the Day overtime, and we'll look at how our short put spread in the XLF has done. Thanks for coming, everyone.